Inside any data center running modern AI, you will find infrastructure generating intense heat. These server racks draw so much electricity, they require specialized cooling systems just to prevent a total hardware meltdown. Nvidia sits at the center of this physical demand, controlling approximately 80% of the market for AI accelerators. This position makes them the absolute toll booth for the entire technological boom. This chart shows the financial result of that control. Nvidia's gross margins, represented by these green bars, sit consistently at or above the 70%. Investors are now identifying a specific next Nvidia trade, finding the infrastructure companies that help these tech giants bypass this Nvidia tax entirely. Hyperscalers are responding by pivoting toward custom ASICs, application-specific integrated circuits. These are chips designed for one specific purpose rather than general-purpose computing. Custom chips are more efficient for inference tasks. The choice is clear: pay the high compute cost of general GPUs or invest in custom silicon tailored for efficiency. This custom path yields massive long-term savings, reducing hardware reliance and giving hyperscalers control over costs. The second escape route involves solving the traffic jams between those chips. Upgrading optical networking equipment allows data to move faster and more efficiently through the data center. Two secondary giants, Broadcom and Marvell Technology, completely dominate these specific hardware solutions. Choosing between them requires weighing Broadcom's established market dominance against Marvell's explosive growth in high-speed networking tech. Broadcom serves as the heavyweight champion of the custom silicon sector, providing the specialized architecture hyperscalers need to make their custom chips function. They currently command a 60% share of the custom AI chip market, a dominant position compared to the fragmented competition. This dominance is fueled by an elite client list, including deep partnerships with Alphabet and Meta. These partnerships are driving massive revenue. Broadcom expects its AI-related sales to reach $16 billion this year, representing a 66% growth rate. However, because Broadcom is a massive, diversified conglomerate, its total stock momentum can feel sluggish. Shares have risen only 13% recently, as other divisions offset the AI growth. Investing in Broadcom offers a sticky competitive moat, though it often requires sacrificing the potential for rapid short-term stock multiplication. Marvell focuses its strategy elsewhere, targeting the data transmission bottlenecks that slow down AI workloads. They utilize optical networking, where pulses of laser light transmit data through fiber optic cables across vast networks at near-instant speeds. Marvell recently achieved a technological milestone by launching the industry's first optical switch capable of processing 102.4 terabits per second. This hardware breakthrough has triggered a massive market reaction. Marvell's stock has nearly tripled as investors pile into the networking growth story. The primary risk here is concentration. Marvell is highly exposed to this single hardware niche, making them vulnerable if hyperscalers slow down their infrastructure upgrades. Marvell provides intense, triple-digit momentum, but it ties your returns entirely to the timing of the optical networking cycle. Assessing these companies today requires looking at the valuation gap, which has grown significantly as AI optimism climbs. Broadcom trades at a forward price-to-earnings ratio of 34, a relatively grounded valuation for a company with its market share. This matrix shows the contrast. Marvell's forward PE hits 76. Despite lower 2026 AI revenue growth of 41% versus Broadcom's 66%, it trades at double the valuation. Against its 5-year average of 31, Marvell's stock sits 55% above its estimated fair value. This creates significant volatility risk. When a stock is priced for absolute perfection, even a slight earnings miss can trigger a sharp sell-off as the multiple compresses. History shows the catastrophic danger of ignoring fundamental valuation during a hot market. In previous tech bubbles, the most expensive stocks were the first to collapse when sentiment shifted. Hyperscalers are funding both of these companies, but the price you pay today determines how much protection you have if the AI trade starts to cool. You can navigate this by matching each stock to your specific psychological risk tolerance. First, there is the GARP investor, growth at a reasonable price. This profile prioritizes market dominance and downside protection. Broadcom is the choice for this profile, offering reliable growth and a safe multiple within the custom silicon sector. Then there is the momentum optimizer, who is willing to tolerate extreme volatility for the potential of triple-digit gains. Marvel belongs in this high-risk quadrant. It offers hyper-growth potential, but it requires active management to handle the inevitable price swings. Capitalizing on the global AI supercycle requires strategic positioning in the very infrastructure designed to bypass Nvidia's dominance.